I'm Barney, and this is the 5-Minute Decoder. Today, we're cracking the code on quantitative easing.
Hmm.
We are doing a deep dive into some really fascinating material from Investopedia, the European Central Bank, and the Bank of England to basically figure out how this whole thing actually affects your mortgage and, your grocery bill.
It is definitely a huge topic.
And to start, you really have to think of it like an adrenaline shot straight to the heart of a flatlining economy.
Right.
But is it really just the government, like hitting print on a giant money machine?
Well, no, not exactly. People always picture these giant pallets of paper cash going brrr, right?
Yeah.
But it is actually completely digital. Central banks are basically just creating digital reserves out of thin air.
Wait, so they literally just type $1 billion into a spreadsheet somewhere?
Yeah, pretty much. And they use that new digital money to buy long-term government bonds directly from commercial banks. They do this when regular interest rates are already basically at zero and, they desperately need a new way to stimulate spending.
So it is kind of like a massive price-insensitive buyer stepping into an auction and just sweeping up all the safest items, right? The government bonds.
Exactly. Which leaves the private commercial banks sitting on giant piles of this newly minted digital cash instead of their usual safe bonds.
And obviously they have to do something with that cash to make a profit.
Right. They put it on sale.
Yep.
They are forced to push further out on the risk curve, which means offering cheaper loans to businesses and regular people just to get that money moving out the door.
Okay, so how does that ripple effect actually hit the listener's bank account?
Well, it changes the math of bond yields. The central bank creates this huge artificial demand for bonds, which pushes the price up and consequently the yield down.
Because yield always moves opposite to price.
You got it. And since government bond yields act as the foundational benchmark for basically all other debt, your everyday borrowing costs just drop. That is exactly why it gets cheaper to price a mortgage or, say, get a small business loan.
But looking at the Bank of England data from our sources, there is a catch here. If you suppress yields, investors go looking for better returns in the stock market or real estate, right? Doesn't that just pump up asset prices and make older, wealthy people even richer?
It definitely does inflate asset prices, yeah. That demographic wealth gap is a very real, documented side effect. Older folks with big, established portfolios see a significant wealth bump.
So the rich just get richer while everyone else watches from the sidelines.
Well, the Bank of England material adds some really important context there. They point out that forcing capital into the real economy also stimulates corporate expansion. So the secondary effect is actual job creation and upward pressure on wages.
Oh, I see.
Yeah, which largely benefits younger, working-age demographics who rely on income rather than asset appreciation.
So the young get the wage bumps and the old get the stock bumps. But if it works like this magic adrenaline shot, why not just leave the IV drip in forever? Like, why can't we just print infinite digital money?
Because of the crash. If you pump too much in, you risk severe inflation and devaluing the currency. And honestly, the scariest part is the lag.
What kind of lag are we talking about?
Usually 12 to 18 months. The inflation does not actually show up in the economic data the moment those reserves are created. Central banks are essentially steering a massive ship while looking in the rearview mirror, just trying not to overshoot.
Wow. And Investopedia points out the system can actually just jam, right? They're like, what happened after 2008?
Yeah, U.S. banks unexpectedly hoarded $2.8 trillion in excess reserves. The central bank flooded them with liquidity, but the broader business climate was so toxic that the banks just sat on the cash instead of underwriting loans.
They just padded their own balance sheets.
Exactly. Which makes the inevitable unwinding phase, called quantitative tightening or QT, incredibly volatile. During QT, they actively have to sell the bonds back into the market to functionally destroy those digital reserves.
So they suck the liquidity back out, bond supply goes up, and suddenly your everyday borrowing costs skyrocket to cool the broader economy down. It is a really powerful temporary lever, balancing cheap loans against the looming shadow of inflation. But before we wrap up, the European Central Bank source mentioned something wild about tokenization and DLT.
Right, distributed ledger technology.
If central banks are already mastering this digital reserve manipulation on a macro scale, imagine what happens to the global financial system if they issue direct digital currencies. They could bypass the traditional commercial banking middleman entirely.
Just beam the adrenaline shot straight to your digital wallet.
Exactly.
Yeah.
Something to mull over until next time. To sum it up in one sentence, Quantitative easing is a temporary digital adrenaline shot that makes your loans cheaper, but always threatens to leave a massive inflation hangover. Thanks for joining this deep dive, and do not forget to subscribe to the 5-Minute Decoder for more.